Welcome to Markets Now. I'm Michelle Rook along with Scott Varilek with Kooima Kooima Variilek. Livestock to the plus side this morning. We're mixed in the grains. Row crops have seen a little easing here after an update yesterday in the grains led by the wheat market. So Scott, let's talk about corn and soybeans. Obviously, this whole grain complex has been putting in war and weather premium. Right now, we're seeing kind of a back off the highs here, but boy, we have had a great run here, haven't we, off the lows?
Yes, and thanks for having me. It's been a very nice run, and like you said, we've got some Russia-Ukraine talk entering back into the markets. It's been a year and a half of that dragging on, and it seems like the news has picked up here again as of lately to put a little premium back in the market. And I think that's what the grains needed if they were going to try to rally. It was solely focused on weather for a long period of time without anything to aid in a little bit of a rally. So then we saw the dollar go down. We saw some of the war talk pick up. That really helped out. And now we're also putting some weather premium back into these markets. Hotter, drier forecast, hotter than normal temperatures coming ahead here. So we're putting quite a bit of premium in based on that. And we can still have, even on the corn, we can still have a large sway in yield yet. And it even could be 50 bushels. You say, okay, we had it planted good in good conditions. Check that box there, going to have a good stand. We had cooler temperatures and some moisture during pollination. Check that box there. So what's the risk going forward? You can go out and pull some early ears and count your kernels, count your rows. And now we have to decide, okay, are we going to see some abandoned kernels? Are we going to see some tip back issues because of this heat, or is the test weight going to be affected? So there's still a lot of risk there on what this corn can yield yet. And we know that soybeans still have a lot of risk, as August is very important to what our yields could be there on the soybeans. So this is a little feather in the cap for the grain markets to rally off of as we do see these hotter, drier forecasts coming. We'll have to stay glued to that. It feels like usually you get after July 4, you can kind of start to put the weather to bed, and it doesn't look like we're able to do that yet. It's going to hang on a little later this year than I expected it to.
Yeah. And we are seeing the market, both corn and soybeans, kind of back off because of maybe some hedge selling pressure here. But, we've had almost a $3 run off the lows in soybeans, and we got above, the 100-day moving average in corn yesterday and closed above it. And so are these areas where you think we need to reward the market?
I do believe so. And I think we are starting to see some hedge interest in both corn and soybeans. And for farmers to hedge early in the year, it's tough to do when you don't know what kind of crop you're going to have, or you're going to get hailed out. Well, what do I have? So now we're getting closer to looking at and knowing a little bit better what we have. So just a few short weeks ago, we were worried about the bottom falling out and thinking that this grain market was really going to have have a tough year to only be followed with a swift rally here and get through halfway retracement here on the corn and get back above $14 on some beans. Very respectable levels to be looking at doing some marketing, in my opinion. Time to get started. And we are seeing some traffic, some picking up of looking at some protection. And for the corn market, the volatility on the grain options, or on the corn options in particular, still seems a little bit on the low side. So we've had a nice rally. You would think, okay, these options are going to start ballooning up with all the risk, but they've stayed fairly reasonable price. So I think protecting yourself both ways, that looks like an excellent thing for me to do, is to look at the option market and decide, okay, we were just down in the low fives. What can I protect down there? We've been over 6. What can I protect up there if I need some upside? So I think that's a great tool to use. And I'd be looking at those heavy, we're only, a few weeks away, or a few months away, from getting into some of that harvest pressure. But I like the low option premium. It also tells me maybe we're finding a spot where we can sort of find a trading range if these options aren't really scared of a large breakout.
Yeah. You mentioned the 50% retracement on corn. 556 is kind of where that is. If we close above that today, do you think we're going to go up another quarter? What's the upside then?
I think you're right. I think it's more like looking at a quarter at a time rather than
Yeah.
we made it through, let's go get above 6 and run. We're probably getting a little bit too close to harvest, and we still have that large acre number that's going to overhang on the corn and say, okay, if we do get a pretty good yield, get some moisture with that kind of acres, we're going to have a lot of corn. So I think it's going to be more like a quarter at a time, even a dime to 15 cents from here. It's going to need an added help if it's going to try to get much further than that 25-cent rally from here.
Yeah. So Scott, cattle up here today. When you and I talked at this time last week, we looked at Wednesday's reversal as maybe a blow off top. That's like the third one that we've had. And we just keep coming back and scoring more contract highs in these live cattle futures. Is that going to be kind of the way we go for a while here, you think?
It feels that way. We've got strength in the market. It's been able to fight off a lot of these breaks. And yes, we had a blow off top risk in April. We had one in June, and now we've had one in July. Every time these all-time highs happen and we have a large rally followed by a quick break, there's going to be those nerves kicking in to say, okay, maybe this is the top. We're going to have that risk. So you have to respect that at that time. But feeders are the leaders. They've been able to fight off every break, and this tight supply is just winning over. The demand has been staying on, I think, better than expected here for the end of July. Seeing where the boxes are priced, I think that bodes well for the market. But this tight supply, we keep hanging on. We're current in the feed yards. The demand for looking at cash feeders is still there. And in the end of July into August, your northern supply gets pretty small. So when you're looking for feeders, prices get pretty high for this next month and a half until we get into some bigger runs. So that's only going to add to it just that much more.
So what are you thinking about cash this week? I mean, from a negotiated standpoint, we were down in terms of numbers last week, especially in the South, but the North, like you mentioned, is so current. Are we going to be able to keep that leverage to get those higher prices, especially as we go into those reports coming up here tomorrow?
Yeah, the North, we're going to try. We're going to try to ask for some higher prices because we can. We've got the leverage. We're current. We're have some 190 asking prices, and guys don't have to take a bid this week. I mean, everybody that had some cattle that were close to ready saw some of the prices that were there and wanted to cash it in. They have, and that's why we're current, because we've sold ahead, we've pulled ahead. We don't have a lot of numbers behind us. And then also when you look at some of the, feeder calf prices and just the low availability of it, it's easier just to say no and continue to feed what you have. Maybe the rally in grains could affect that a little bit as we get a little bit scared again of the corn rallying and what the high feed costs did to us last year. So that might play a little bit of factor in what these carcass weights could do going ahead. But the South has not been able to carry their weight. The largest cattle feeding state in the nation traded 513 head last week to set their formula price, and that's just an embarrassment. And it's hard to establish a market based on that low of a trade number. So part of me says that's why the North can trade that much further north of the cash. So have a nice big positive basis when generally we don't figure on having leverage and figuring maybe a negative basis on a normal year, but that's definitely not the case. And so I think that's what's holding us back. It would help the futures out if there was some better southern trade. That's what's holding us where we are. Otherwise, I think we could really establish some higher prices quickly.
Now, we may not see cash trade, obviously, until after the reports, but we have both inventory and cattle on feed on Friday, and those are expected to be quite bullish in confirmation of these tight numbers, right?
Yep, that very well could happen. The old cash cattle Friday, the way it used to be, is we've seen if you're holding out throughout the week, the prices have been getting better. We're still using that kind of formula, so guys are seeing, okay, if I sell out early, somebody's getting a higher price later. So that just makes us all want to wait back and until that doesn't work. And it's been working so far. Cattle inventory, cattle on feed report, those have been friendly, and we're expecting that again. That does get priced into the market. We're all very aware of it, but these reports have not been hurting us. And I think we're going to really start studying these cattle inventory reports more than normal, just to try to see, are we getting some heifer retention? Are we getting some growth in the cow herd expected or not? That also means, okay, are these heifers going to be in the feed yard or are they not for the next year? Are we going to be tighter on supply? If not, if they're going to the feed yard, then we still have levels that we have not seen coming to us.
Hogs, again, up, and it seems like the cash market has basically outperformed. The lean hog index continues to rise. Is that what's pushing this market yet?
Yeah, it's some of that, and I think the carcass weights were something that we looked at, saying, okay, they're above year ago levels. That's a pretty negative sign. There was some selling that happened in the markets, only to be found with a turnaround and a rally higher. And now we have a gap higher today as things stay strong. We do have some increased put selling happening today. That happens once a month. And today is when some of those line up, where there's quite a few trades selling some puts. And I think when the computers, the algorithms see all this extra volume coming into the market for the upside, it doesn't take them long to try to push some of these markets higher. So I'm going to put some of the reason we're up on that, but $2 higher is a pretty strong trade, and is saying, okay, cash is staying on better than expected. July went off above $1, and now August is finally closing that gap.
Yeah, I saw that, and I wondered if you think we'll get over 100 here or not.
We have made it now, and now can it hold? I guess.
Okay.
I wouldn't have expected it to. I would have said no probably a few days ago. So I guess I'm wrong. So it is as of now.
All right. Thanks so much for joining us. Scott Varilek with Kooima Kooima Variilek. That's Markets Now.